Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. Tech stocks are rallying on AI optimism, and overall major indices are getting a boost. But right now, there's under an hour to go until the closing bell, and stocks, they are higher. Let's take a quick look at the popular averages here. The Dow up 280 points. Your broad gauge S&P 500 is up about 0.5%. And your tech-heavy NASDAQ is rallying about 1%. Let's welcome our data and markets editor, Jared Blickry. Jared, what are you seeing in today's trading action?
You nailed it at the top. This is a tech-driven and led rally, kind of contrasting what we had yesterday, which was more broad-based, included a lot of broad sectors. And we'll get into some of that in a minute. Just want to show you the Dow intraday. And you can see we gapped up on the open, and we've just been hovering around, let's say the 50% line, 0.5% most of the day. NASDAQ up about double the Dow. And you can see we've been in a nice trend since the noon hour. That's up 1%. S&P 500 also up 0.5%. Dipped into the red slightly earlier in the day, but have erased that. I want to show you what's happening with the Russell 2000, though. A lot of the smaller issues, especially ones that we saw strong yesterday, taking a little bit of a breather today. Let's call it that. Russell 2000 in the green slightly, but for the most part, been in the red all day for about 0.5%. And real quick here, we'll take a look at the VIX. We can see it's slightly elevated, but well under the 20 level. And that was a threshold that we crossed a few days ago. We saw it elevated a couple weeks ago on the China tariff scare, but that has kind of come back to what we would say prior averages. Now, the 10-year T-note yield, that is down 1 basis point to 3.98%, and we're also seeing the 30-year down 2 basis points. That's down to 4.55%. U.S. dollar index also down. And what's interesting to me about the sector action, only tech today is outperforming. So that's XLK, 1.3% versus the S&P 500, 0.5%. But we're also seeing green in consumer discretionary and materials. What's not working today, real estate and utilities. Those are two interest rate sensitive sectors, but not really seeing too big a move in interest rates. Before I go here, I want to show you, we got 4 out of the 7 Mag 7 names hitting records today. Nvidia is a leader among them, up 5.5%. Broadcom up 3%, Tesla up 2%, Amazon 1%. And I want to show you the Dow before I go here. You can see a lot more green than red, but we do have some notable downside movements in Walmart, almost down 1%, J&J down 1.5%. For the most part, this is a tech-driven rally with a few other sectors mixed in. And I'll throw it back to you, Josh.
All right, thank you, Jared. When Nvidia CEO Jensen Huang delivering the keynote address at Nvidia's GTC conference there in Washington, D.C. on Tuesday, announcing a bunch of new partnerships, including with Uber, CrowdStrike, and the Department of Energy.
Today, we're announcing that the Department of Energy is partnering with Nvidia to build 7 new AI supercomputers to advance our nation's science. I have to have a shout out for Secretary Chris Wright. He has brought so much energy to the DOE, a surge of energy, a surge of passion to make sure that America leads science again.
For more, we're bringing in now Daniel Newman, CEO at Futurum. Dan, it is always great to see you. Maybe start here, Dan. You know, the big debate, which we've discussed, Dan, AI boom or AI bubble. You have Nvidia there today making just a slew of news, right? All these announcements, the energy department, Palantir, Uber, Nokia, CrowdStrike. Does all this, Dan, does it give us any greater line of sight, any clarity into that debate, AI boom or AI bubble?
Josh, good to see you. The Super Bowl of AI now happens more than one time a year. That's great. It was a big moment, and you saw the stock rally over $200. Big inflection, big moment for the company. And I've been trying to burst the bubble bear's bubble for some time now. Everyone's saying it's a bubble. Well, Jensen came out and helped my cause. He basically said he has line of sight to $500 billion in revenue for Blackwell Rubin through the end of 2026. And those partnerships that you mentioned, whether it's CrowdStrike, whether it's Palantir, whether it's ServiceNow, the DOE, these are all commitments to consume massive amounts of AI, massive amounts of GPUs, all of this infrastructure that people are questioning. Is it a circular deal? Are there only a couple of companies benefiting? We are seeing that moment, Josh, where the pivot happens, where people are willing to spend money to get value from AI. I've been saying this for a while. Jensen did a great job validating it today.
On that point you mentioned there, Dan, this kind of web of circular deals, all right? I wanted your take on this, because this was another announcement today. This Nokia news, from what I understand, Dan, Nvidia invests $1 billion in Nokia and then Nvidia chips will be used to accelerate Nokia software for 5G and 6G networks. To your point, this is a yellow flag some have been throwing here, right? These kind of circular web of deals where folks say, Nvidia invests in company A, and then company A is going to use Nvidia's tech. In your opinion, is there any kind of warning, a yellow flag? Do you get .com echoes there, Dan?
I don't see the .com echoes. What I do see is Nvidia as one of the largest companies, now the largest by market cap in the world, picking key secular trends, in this case, 5G, 6G, communications, connectivity. I'm walking around Washington, D.C. here at the event, and there's times where I can barely get signal. We need to make these improvements. AI working with the 5G and then 6G communications technologies can improve connectivity. It can improve the amount of energy used to deliver that connectivity. There's so many benefits. So Jensen right now has the opportunity, leading Nvidia, to pick these companies that he wants to collaborate with. Now, of course, the fact that so much of this is built on Nvidia is a tribute to their success right now. And this is why when you hear about companies like Broadcom, companies like AMD winning more deals, I think that's a good thing. But I think going into this week, what we're going to really want to hear is from these cloud companies. For instance, Microsoft and Amazon, they're reporting this week, and as well as Alphabet. We're going to want to hear that their growth is more consumption of AI by these enterprises, by these businesses, by these government entities. I think Jensen was sending signals. I think he was giving some breadcrumbs with some of these deals he's making. But these are the largest companies in the world using that technology to build products that are going to be consumed. That isn't just going to be 5 or 6 companies. I think it's all very positive.
Dan, great to see you as always, my friend. Appreciate it.
Good to see you.
And we'll have more on the ground reporting from the conference. It's coming up later in the show. Let's get more on today's market action with Interactive Brokers chief strategist. That would be Steve Sosnick. Steve, always great to see you, especially on set. So I have another day of green on the screen. Everything's up, Steve. I'll have some folks, they sit in that very chair. They say, of course it's green because the economy's resilient and earnings growth is healthy and Jay Powell's going to cut. What's not to like?
The thing I fear most is the lack of fear at this point. I think the fact that it just sort of seems inevitable that every day we're going to go up, and it's like almost too good to be true.
We can't just enjoy it. Can't just enjoy the ride up.
We are enjoying it, but I think you have to be a little bit wary of the fact that the trees don't grow to the sky.
Why? Let me ask it this way: what's on the Sosnick radar of concern? What could derail us?
First of all, I think the market's placed a lot of enthusiasm on the trade talks that are likely to happen this week. We've seen that go awry. We've seen some of those deals sort of turn out to be frameworks, not deals. Again, this is not a problem. Let me just state that this is not a tape to be fighting right now. So I'm just basically saying, okay, here are the things that could derail this bullet train riding down the tracks. And I think they all warrant some consideration. We also get earnings. This is a huge earnings week, as
big names on deck.
Just alluded to, right? So on tomorrow alone, we have the Fed meeting, we have Microsoft after the close, we have Meta after the close, and we have Google after the close. So any one of these things can derail the market because part of it is, everybody's expecting nothing but great news from the Mag 7, and we heard, when you throw in Nvidia, that's like 6 of the Mag 7 we're hearing from this week, not so much in earnings. But also in the Fed meeting, everybody's decided that the Fed is cutting rates, and that, it's pretty much priced in that quantitative tightening is going to come to an end, which is also good for the market. Well, are they going to commit to future rate cuts? Are they going to acknowledge that that basically we're in a situation where let's just ignore the inflationary pressures and just focus.
3% is the new 2%? Is that kind of thing?
See, that's the problem. Yeah. Is 3% the next? Somebody wrote recently, it might have been someone in the Wall Street Journal, that is the 2% target a target or a suggestion? And I think that's a very fair way of putting it, because we're solidly at 3%. Yes, the last GDP report that we got was a positive surprise, and that was a reason for rallying. But can we just sort of say, all right, we're okay with 3% here? So there's basically, when you think about it, no matter where you go, there's a good scenario priced in, and it just means that are we going to continue to draw to an inside straight all the time? That's a tough thing to say, which is why my mantra has been don't fight the tape, but insure against it. And when you have things like VIX 16-ish, 15, 16 level, which by the way ticked up a little bit today because there is a little bit of, just maybe a little bit of maybe we should hedge some of these events this week. It's just, I think you have to be opportunistic in that sense, and maybe not go shorting all these stocks, which can be perilous, but maybe you want to say, all right, the market has shown you that they're susceptible to hiccups when they come.
What you mentioned those big tech earnings on deck. Just tying back to AI, do those big tech names, Steve, when they report, do they have to say, yes, AI CapEx is going to keep increasing from here? And what if they don't?
Well, then there's one of those scenarios.
Yeah.
That's the thing is it's baked in that the AI spend is going to continue more or less ad infinitum. Meanwhile, we heard Meta basically cutting a lot of people in AI. Maybe they've spent a little too much. Now, you can argue that the whole point of AI development is to allow more efficiency, which translates into people losing their jobs. But that may be part of it. Amazon, again, with their cuts, maybe that's part of it as well. Or, is it just a fig leaf for companies saying we overhired and, we're going to use this as our excuse to say that AI is working on our behalf. But right now, the whole market, the whole ecosystem is based on the fact that money will continue to be spent at an increasing pace on artificial intelligence. And at some point you have to wonder, is that sustainable? And I point to the example, I know the prior guest did not see echoes of the internet bubble, but I'm thinking to a certain extent that there are echoes, and history doesn't repeat, but it often rhymes, of the bandwidth build out that we saw in the internet era, where let me stipulate, we needed the bandwidth, and there were companies very happy to build it. And some of those huge winners who were building the infrastructure that built the internet are such illustrious names as Lucent, Global Crossing, Northern Telecom, WorldCom, Enron. Sense a pattern here? So the problem is, which is not to say that any of these big companies are frauds or doomed to go bust. That's not. Nokia was one of them as well, which I've had in my portfolio for years. I'm like, oh my gosh, this dead money stock is helping me out, but it was by accident. And so, I do have to say that that's the caution there, is that this gold rush into AI. It's tough to sustain the enthusiasm and the high levels of profitability and growth that are priced into these stocks.
Steve, always great to see you, especially on set. Thank you.
Thank you so much.
Coming up, gold is trading lower. We'll explain why when we return after the break. Stick with us. As great as always. Gold prices plummet below the $4,000 mark, a stark reversal from the precious metal's recent ascent. Senior reporter Inez Ferre joining us now with the latest. Inez.
Josh, as you just mentioned, we're watching gold prices that are down more than 1.5%, extending declines from yesterday. And of course, last week when we saw that sharp sell-off last Tuesday, the sharpest sell-off in one day in more than a decade. Something interesting to note here is that Bloomberg has been pointing out that gold is doing what it typically does after the Fed starts cutting interest rates. There's a period of weakness before 10 to 12 weeks afterwards when you see the gold rally again. Because remember that gold does well when interest rates are lower, and the market has been anticipating that we will get more rate cuts this year and going into next year. Of course, some of this weakness is coming as optimism over a China-U.S. trade deal rises. So investors have been sort of fleeing from this safe haven. But make no mistake, you're looking year to date at gold that's up 49%. At the height of the rally, it was up about 60% for these gold futures. And you still have major banks like UBS, like JP Morgan, Goldman Sachs, that are all predicting that gold will go higher into next year, Josh.
All right. Thank you, Inez.
Thank you.
Well, Bitwise is launching a spot Solana exchange-traded product, giving investors direct access to one of crypto's fastest-growing networks. The Bitwise Solana staking ETF is now trading on the New York Stock Exchange under the ticker BSOL. And joining me now, we've got Ryan Rasmussen, head of research at Bitwise. Ryan, it is good to see you. So you launched a new Solana ETF, first U.S. fund, you say, Ryan, that gives investors full exposure to Solana. Start there. Just walk us through the product, Ryan. What does it offer and why launch this now?
Yeah, happy to do that, Josh. Great to be here with you today. So yes, today Bitwise launched the first spot Solana ETP in the US, and it's actually one of the first crypto assets that has an ETP with built-in staking, which means investors can participate in Solana's staking reward, something like 7% on average annually. But fundamentally, what it does is provide spot exposure to Solana, which is one of the leading crypto assets and one of the leading programmable blockchains, in an ETF wrapper, which most traditional investors are familiar with. That gives them institutional grade custody. It fits into the workflows and pipeline reporting of traders and investors and financial advisors. And it finally removes all of the hassle of dealing with crypto assets directly. So we're really excited about this product. You can think of it like the Bitcoin or Ethereum ETPs that launched last year. And now we're happy to bring a Solana ETP to the market for US investors.
You know, a more basic question, Ryan, but I'm thinking it could probably be helpful for some folks, for the uninitiated. You hinted at it there, but just pull on this for me. Explain what Solana is, why investors should be excited, and how big you think that opportunity ultimately really is.
Well, certainly. So Solana is one of the most exciting crypto investment opportunities that exists today. If you think about what Solana does, it provides a service. Now, that service is the ability to transfer dollars and bonds and other assets over a blockchain. It does this insanely fast. It's one of the fastest blockchains that can process more than 100,000 financial transactions per second. And it does it at an extremely low cost, less than 1/10 of a penny for a median transaction fee. And so when you think about things like stablecoins and tokenization, which are two mega trends in the digital asset space for now and for what we believe is years to come, the infrastructure underpinning a lot of that activity are blockchains like Solana. So if you believe, like we do, tokenization and stablecoins are going to be one of the biggest trends in financial markets and in technology over the next 4, 5, 10 years, then you're going to want to get exposure to the underlying theme in your portfolio and the underlying infrastructure that supports that growth. And that is something like Solana.
Before committing capital to the ETF, Ryan, in your opinion, what are some risks investors should have on their radar, though? Would it be token volatility? Would it be, regulatory clarity? What should they know?
Yeah, so the wonderful thing is that the regulatory clarity that we've gotten over the past 9 months has been extremely powerful for allowing investors to gain access comfortably to crypto assets. That's why we've been able to bring ETPs like the Bitwise Solana staking ETP to market. We now have a crypto-friendly SEC. We have SEC Chairman Paul Atkins making speeches regularly about how crypto and how tokenization and stablecoins are the future of financial markets. So now investors can comfortably allocate to the space. And that's certainly what we're seeing the investors that we speak to talk about. They can comfortably allocate to the space without fear of regulatory enforcement or regulators coming after these projects like Solana. But there certainly are risks to investing in the crypto space, just like there are risks to investing in any other new type of asset or new technology. Crypto is somewhat volatile as an asset class, as I'm sure all the viewers here are familiar with. But what's important when you think about investing in crypto assets is how it fits into your broader portfolio. And when you look at the data, what you typically see with crypto assets like Solana is they have the potential for high returns. They do come with volatility, but they're uncorrelated with traditional assets like stocks and bonds and gold, which you just spoke about on your show. And so when you think about constructing a diversified portfolio that's built for the future, something like a crypto asset like Solana fits very well into that broader portfolio construction discussion. And that's what a lot of the financial advisors that we're speaking to are thinking about as they add crypto into their portfolios and their client portfolios.
You mentioned the regulators, Ryan. What about the Fed? You got a Fed meeting on deck. Investors bet that a cut is a lock. If you have a sort of shifting Fed policy environment, Ryan, how does that impact investor appetite, do you think, for risk assets like crypto?
Well, Josh, historically, crypto has benefited from a low interest rate environment alongside other risk assets. And what we've seen so far as the Fed has pivoted from this rate hiking to rate cutting regime, is that crypto assets have benefited. Solana, Bitcoin, Ethereum are all doing tremendously well in 2025 and since 2024 when this pivot really began. So if investors are positioning themselves for a low interest rate environment, risk assets should do extremely well in that environment. And I would bucket something like Solana alongside other high-tech growth investments that you'd want to have exposure to in a low-rate, high-growth environment.
Ryan, great to see you. Thank you.
Thank you, Josh.
All right, now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me here for a look at VF Core and CoreWeave. We're going to start with VF Core, the retailer topping earnings and revenue estimates for second quarter, but guidance seems like it fell short of the street's expectations, Brooke. So VF Core, of course, we're talking about the North Face, the Vans owner, issues third quarter adjusted operating guidance that misses. It looks like the street does think maybe guidance was conservative. Most do have a hold on this one. I saw Stifel cite as saying the quarter shows sequential improvement towards 2026 goals, though they say we look for greater validation of a return to consolidated growth.
Yeah, and that's what we're hearing similar from other analysts on the street. CFRA saying that we believe investors view this as early innings of a turnaround story. And that fourth quarter guidance, that was really what Wall Street seemed to focus in on, is that they projected a 2% year-over-year sales decline for the fourth quarter. Now, the CEO tried to hedge against this. He said in the call, we feel like we've got a good plan, we got good products, we're optimistic, but it's a little too early to say how it's going to play out. There's uncertainty out there about the overall macro environment. There's the shutdown, etc. And the consumer, though, has been stubbornly positive, and I'm hoping that will happen again. And so this rhetoric seems to have bled into investors' mind, especially that's a pretty harsh outlook when it comes to the key holiday shopping season.
All right, turn to CoreWeave, another name we're watching, a company announcing plans to make a move into the U.S. federal market, Brooke. So this one, it sounds like basically expanding the commercial business into the U.S. federal market, that vertical. Sounds like it's about delivering AI cloud services to the U.S. government agencies and their partners, of course, a name that has made a big move.
Yeah, big move. This stock is up more than 250% since it went public. And in this release that we got from CoreWeave this afternoon, the CEO said that America's economic competitiveness and national security rely on the continued advancement of secure, high-performance AI infrastructure. And so we're not seeing too much momentum off of this. In fact, as we make our way down to the close, the stock is down about 0.8%. But when you think about the run-up and the momentum that this stock has had now with this latest partnership with the U.S. federal market, this is certainly continues on the momentum that's already seen so far and perhaps is baked into the price here.
All right, thank you, Brooke. We are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. That is the closing bell on Wall Street, and now it's Market Domination Overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. And Yahoo Finance's Jared Blickery joining us now with the latest market action. Jared.
Thank you, Josh. We got a trifecta in the majors of green and record highs. So that's a record high for the Dow Jones Industrial Average. And I'll show you the intraday chart right here. You can see we fell off over the last hour, 2 hours there. Still closed with about 170 points or 37 basis points. NASDAQ was up about twice that, 84 basis points or 0.8%. And you can see pretty close to its highs there. And we were climbing throughout the entire afternoon. And it really was a day of concentration. Here's the S&P 500, closed with about 0.2%. And what do I mean by concentration? The gains today were concentrated in some of those bigger names. So I'm going to give you another look at the S&P 500. Here's an equal weighted view. That lost money, 0.9%. Did not have good breadth or participation today under the market's hood. Nevertheless, we did get those 3 records. Also got a record in tech. XLK, the best sector, the only outperformer of the S&P 500 here. Also saw a little bit of green in materials and consumer discretionary. For the most part, we didn't see a lot of participation, and we did see some serious downside action, or somewhat serious, in real estate. That was down 2.25%, and utilities down 1.5%. Also, energy and staples each off about 1%. And looking inside the NASDAQ 100, you see some nice dark green. Nvidia, another record high. It's been it's been a week or so since we saw one in Nvidia, but that was up about 5% today. Broadcom also up 3%. Alphabet hit an intraday record high, but ended up closing in the red, down about 0.2%, and Tesla up 1%. Want to draw your attention to the semiconductor space, because you'll see the left part of the screen there, 2/3 of it pretty green, even Intel up 5%, but a lot of the smaller names just did not participate. So even within tech, we see this theme of the bigger names really getting most of the action, and almost a similar story in software as well. So I'll close with our ARK Innovation Fund, and you can see some of those big names again really getting it done, but for the most part, we see a bit more red than green in disruption. Josh?
All right, thank you, Jared. Well, stocks trading at new highs here, but the next big test will come with big tech earnings this week. Our next guest notes AI as a whole has contributed to market frothiness. For more, let's get to Monachill with Capital Partners Managing Partner and CIO Ali Melli. Ali, it is great to see you. Let's start there. Talk about AI, because Nvidia, of course, has the big show in our nation's capital today. They made all kinds of news, Ali. The stock popped about 5% in today's trade. You say here, I thought this was interesting, talk about AI, Ali. You say, very promising in boosting productivity, but you think valuations have gotten ahead of market reality, and you say you see risks. So let's stop there. Where do you see the risks, Ali?
The risk that I see is mainly in valuation and accounting. So let's take a step back. The average leasing price for an Nvidia H100 GPU at the beginning of 2024 was $10 per hour. Now that number has dropped to $2 per hour. So you see an 80% depreciation in equivalent of rent that you can pay, or you can, if you are an owner of a GPU, this is how much you can earn for renting out your GPUs. On the other hand, if you look at the depreciation curve, a lot of the buyers of Nvidia chips use 4-year, 5-year depreciation. So they only depreciate that by 20% per year. Now, where does that translate into corporate earnings? That means that you get exaggerated corporate earnings in the sense that you get the revenue growth up front, but the depreciation is back-ended. If you look at the hyperscalers in the past year, they have spent around $400 billion on AI-related expenditures. Their total revenue growth, whether that was from AI or other sources, was only $200 billion. So if they were to actually depreciate the AI expenditure and look at it as an upfront expense, that would have been a loss. Now, because they amortize the cost that they are putting right now over a 5-year period, they are showing income growth on top of revenue growth. But the question is that revenue growth sustainable? And if they actually were going to use a depreciation curve that captures the economic reality of it's a new technology, the same way that like a used cell phone depreciates a lot in value. If you use the same depreciation logic, if you look at Moore's law, for example, if they were to depreciate their assets by 50, 60% over a 2-year period, I think a lot of their earnings would be significantly lower.
So accounting rules playing a role here. I'm interested, is the ultimate risk though, Ali, it's overbuilding, it's stranded assets, is that it?
That is the risk, and that gets encouraged by the accounting rules, because the accounting rules encourage investment, because people say, well, look, if we buy Nvidia chips and we can show some revenue growth, that equity market is going to reward us. So people might overbuy Nvidia chips, they might overbuild data centers, we might even overbuild power that gets into the data centers. So that can create a cascade of overinvestment across the economy, and then at some point you might end up with stranded assets, or with assets like the same phenomenon that happened with office buildings. People need offices. We are sitting in this beautiful office right now. But if you overbuild offices, at some point the rent that you can get is not going to cover your capex. And right now the risk that I see is that we build too much assets, Revenues will not be covered, the capex that went into them, and at some point, people are going to take losses. Similar to what we saw in the telecom, essentially boom and bust in late 1990s.
You're actually going, I was interested there because this AI credit boom that you see, I wanted to pull on that with you. I want to see, do you see similarities, I guess, to other speculative cycles that you've watched, that you've studied?
There are some similarities.
Yeah.
Obviously, there are some real differences.
Yeah.
We all use cell phones today, same way that WorldCom was in the business of building, telecommunication infrastructure. But at the end of the day, there were some overbuilding. Like no one remembers Nortel these days, or WorldCom, or some of these other companies that went under. And there are some similarities that there are companies that are zombie companies. They have negative income, negative revenues, but money is being invested in them and they are building assets. And I think that is going to be a risk, that there are going to be clear winners. There are going to be clear people that are going to become equivalent of Verizons of AI age, but there are also going to be clear losers that they will never recover the capex that they put into AI infrastructure.
So if I'm an investor, I'm listening to this, Ali, are there certain signs or signals that would tell you, okay, this AI credit boom is starting to go south?
I would look at essentially income statements and operational cash flows. We need to understand which one of these companies are getting positive cash flows from operations. Which one of them, how much they are putting in capex, and is the revenue essentially growth matches the capex increase. If at some point we make an adjusted accounting measures and expense all of the capex upfront, which one of these companies will go into a money-losing mode? So, and again, that's very similar to what we saw in late 1990s, early 2000. We had a lot of companies that were showing artificial profit on the paper, but when you look at the statement of cash flows, you would see negative cash flow. And that also feeds into the credit cycle. Like the fact that a lot of the AI projects are relying on credit from private credit funds, for example, to expand, to operate is a warning sign. Because if you look at, for example, cost of capital for Microsoft or Facebook or any of the hyperscalers, their cost of capital in theory is far less than what they pay in the private credit market. So the fact that someone is willing to pay extra money to borrow money in private credit market to keep the debt off balance sheet, that to me is a warning sign as well.
Ali, such a fascinating discussion. Thanks for your time today. Appreciate it.
Thank you very much for having me. It was great being here.
Coming up, Nvidia making a splash with a cascade of announcements. Our tech editor has all the latest news investors need when we return. Nvidia making a lot of news at its GTC conference in Washington, D.C. on Tuesday, including a partnership with Uber.
Dara K. Dara is we're working together to connect these Nvidia Drive Hyperion cars into a global network. And now in the future, you'll be able to hail up one of these cars, and the ecosystem is going to be incredibly rich, and we'll have Hyperion or robo-taxi cars all over the world.
Joining me now on the ground from D.C., our very own tech editor, Dan Howley. Dan.
Yeah, Josh, obviously a ton of announcements here from Jensen, from NVIDIA. He's just had a press Q&A where he was discussing things related to the U.S. and China, basically saying how the U.S. is ahead as far as AI goes, way ahead as far as chips go, but there is the risk of falling behind if we don't continue to invest in AI and continue to see immigrants come in and start to work in those areas. He also, during the event itself, laid out a number of announcements, including a deal with Lilly, which will see that company take 1,000 GPUs to work on drug discovery. Also working with, obviously, the Department of Energy, building out 7 supercomputers for the department, including one that will have 10,000 GPUs, and then just a litany of other deals, such as with CrowdStrike, and so on and so forth. And this is just kind of the cadence that we see with NVIDIA events, where they host these big get-togethers, these GTC conferences, whether here in DC, the main one in San Jose, or across the world, and they have these major announcements, and it helps to push the stock price forward. I think it's worth pointing out, this all comes as the company's market cap closely approaches the $5 trillion mark. The company hit $4 trillion in July.
All right. Thank you, Dan. Appreciate it. Amazon reporting third quarter earnings on Thursday. This is coming after the company announcing 14,000 in corporate job cuts on Tuesday. For more, we're bringing in now Arun Sundaram, Senior Equity Research Analyst at CFRA Research. Arun, it is good to see you. So, you look at the stock of Amazon here, Arun. I mean, nice run in the past 6 months, but even so, we have not done much this year. But let's start with AWS, the profit engine here, the cloud computing business. I'm interested, what kind of growth, what kind of margins do you expect to see there, Arun, now and ahead?
Yeah, thanks for having me. Yeah, so the most important figure for Amazon is really on the AWS line. So the last few quarters, AWS has been growing around 18%. Investors are going to demand that AWS growth accelerate from that rate. So we're modeling 19% AWS growth this quarter. That's in line with consensus. And really next year in 2026, the focus will be on whether we can see 20% plus AWS growth. And I think we can get there because number one, Amazon's still seeing more AI related demand than capacity, which is why it's ramping up all its CapEx. So that will be better monetized next year. And then number two, Amazon's one of the largest investors in Anthropic. And Anthropic is using Amazon's capacity, its chips, its servers to train its next generation cloud models. So I think you'll see more contribution from Anthropic next year as well. So yeah, like I said, I think this quarter 19% growth will be the bogey, and then next year the real focus is on whether AWS can hit that 20% plus growth.
In that great cloud computing war, Arun, think Amazon, Microsoft, Google, increasingly Oracle, how would you define Amazon's competitive advantages there?
Yeah, well, I mean, Amazon has an advantage in the sense that it's the clear market share leader in cloud computing by a long shot too. If you look at the AWS business today on an annualized basis, it's generating about $130 billion in annualized revenues. In 2019, prior to the pandemic, it was about $35 billion. So it's grown about almost 4 times since 2019. And we've yet to see meaningful contribution from AI related demand. AI is just a small portion of that $135 billion of annualized AWS revenue. So I know investors that I talk to right now, they're really excited to see when Amazon will hit that $200 billion mark in AWS, because like I said, they're still very early days in monetizing AI.
What about the core retail business as well, Arun? I want your take there. What is your sense of how consumer demand is holding up? You do have obviously the cross currents, got tariffs. It seems like relatively mixed consumer confidence data. What do you expect?
Yeah, no, I think we're expecting a strong quarter in the e-commerce business, a continuation from the trends we've seen in Q1 and Q2 for Amazon. What's going well for Amazon right now is that they're really focused on increasing their delivery speeds, even though they have some of the fastest delivery speeds out there. And at the same time, they're taking costs out of their business. They're becoming more efficient, more robotics, automation. They're re-engineering their fulfillment network. So it's really been a win-win for Amazon. And e-commerce is obviously the largest business for Amazon. And so as we see margins continue to improve in that e-commerce business, that bodes well for Amazon's total margin profile, especially given that e-commerce margins are improving. AWS has stronger margins than e-commerce. The advertising business has even stronger margins than AWS and e-commerce. So that's another reason we like the stock too, is because Amazon's one of the it's one of the best margin mix shift stories in the entire market, because this is a company that's generated $700 billion in annual revenue, but its fastest growing businesses are still relatively small, meaning advertising AWS is still relatively small compared to the e-commerce business.
What about, Arun, that recent, Amazon's AWS outage? We were all talking about it as a financial analyst. How do you think through that? Is there risk there? Bad news for Amazon. Could that have been good news for rivals? Maybe pick up a few customers.
Yeah, I think we'll hear a lot about that on the call on Thursday. I think the first thought is that you realize just how important AWS is to the global economy. When AWS went down, you saw so many different companies become affected, and again, it's because Amazon is the clear market share leader in cloud computing. So I think it's an indispensable business, and we'll have to see. I don't think this is necessarily a net negative for Amazon. I think it's clear that it's not easy to move from one cloud provider to another, and but I do expect that we'll hear probably a lot of questions about that AWS outage on the call.
And Arun, on this news that Amazon's going to cut about 14,000 corporate jobs, Bloomberg citing sources saying it's going to impact payments, logistics, video games, the cloud computing unit. How should investors interpret that, Arun?
Yeah, I think so. This is 14,000 jobs that they announced that they'll cut. There's likely going to be more, maybe throughout this year and next year as well. But I think this is a part of the routine job cuts, and I say that because a few years ago, in late 2022 and early 2023, Amazon had about 27,000 job cuts. So this is a little bit smaller than that. If you look at 14,000 jobs, it's about 4% of its corporate workforce. So it's not insignificant, but it's also not overly significant. I think we've yet to see the real AI-related job losses. I don't think any of these 14,000 job cuts is related to AI and the efficiencies from AI. I think that will come over the coming years, especially as Amazon introduces more automation and robotics throughout its fulfillment centers. But yeah, I think what's we'll be kind of watching for is to see how much can Amazon grow its revenue over the next 5 to 10 years versus its employee base. And so we're expecting relatively stable, a relatively stable employee count over the next several years, whereas revenue is probably going to grow at a 10% plus clip each year.
I'm interested, Arun, though, whether you think this, Amazon and the job cuts news, any way could be sort of canary in the coal mine, Arun, that we could see a wave of tech companies making similar cuts.
I think every single year we hear, these companies make routine, these kind of job cuts. And a lot of that is because over the first few years of the pandemic, there was some heavy hiring going on, and there was a lot of bloat in a lot of these tech companies. And now you're seeing a lot of these tech companies start to cut middle management jobs to try to flatten the organization a little bit and try to make them more efficient. So I think we'll hear more of these sort of job cuts. These, I think, probably around the 5 to 10% of corporate workforce, that kind of range among these tech companies, this year, next year, and probably the foreseeable future.
Arun, always great to have you on the show. Thank you.
Thank you.
Well, Apple's chief turns 65 in a few days on November 1st. If he chooses to retire, Apple has big shoes to fill. We take a look at a few potential candidates that may be under consideration.
Good morning. Welcome to Apple Park.
Apple may not be the powerhouse it's become without CEO Tim Cook. He served in the position since 2011 and has overseen the rollout of some of Apple's biggest products, including the iPhone X, the launch of its TV streaming platform, Apple TV Plus, and ushered in Apple's push into financial products with the Apple Card. Now the company faces pressure from Wall Street over its slow move into AI and the search for its next big product post-iPhone. This has led analysts at Lightshed Partners to question whether it's time for Cook to step aside and make way for a product-focused CEO. Right now, there's no indication Cook is in danger of losing his job, but Cook is 64 years old, and despite his successes, he won't lead the company forever.
Cook continues to be the Hall of Fame CEO. He will lead Apple, I believe, at least the next 5 years.
It wasn't that long ago that you could give Tim Cook credit as having created more value as a CEO than any other CEO in history. And we're talking about like 2 to 3 years ago. It's not that long ago.
I think there's a sense that, maybe some fresh blood in terms of the thinking within executive management would make some sense.
That leaves the question of who will take up the reins of one of the most important technology companies in the world. Jeff Williams, Apple's previous COO, was once seen as Cook's potential successor, but he's retiring from the company later this year. Still, there's no shortage of top candidates at Apple who could take over for Cook. Craig Federighi, the company's senior vice president of software engineering, leads development of its Mac and iOS products. He also makes regular appearances at Apple's Worldwide Developers Conference, making him one of the most visible candidates in Apple's lineup. John Ternus is also a solid option as Apple's future CEO. He's been with the company since 2001 and has overseen the development of a number of products, including the iPad and AirPods. Perhaps more importantly, he's also been instrumental in Apple's move away from using Intel chips in its Macs to its own processors. Greg Joswiak, Apple's senior vice president of worldwide marketing, has worked at Apple since the late 1980s, giving him a wealth of knowledge about the company and its various products and services. Eddie Q, Apple's senior vice president of services, currently leads the company's most important business segment outside of the iPhone. He's been with Apple since 1989 and brings the institutional knowledge necessary to navigate such a massive company. And then there's Deirdre O'Brien, Apple's Senior Vice President of People and Retail. A 30-plus year Apple veteran, O'Brien brings along the experience and understanding of Apple's customer base that the company needs to ensure it's meeting user expectations. Cook's still on top for the foreseeable future, but it remains to be seen what Apple's leadership could look like down the road.
Time now for what to watch Wednesday, October 29th. We're going to start off on the earnings front. It is a big week for big tech with 3 magnificent 7 names reporting on Wednesday. That's Microsoft, Alphabet, and Meta. Microsoft announcing first quarter results after the closing bell. Analysts expecting the company to say it's spending even more money to build out its AI and cloud infrastructure. Capital spending also in focus for analysts. That could rise by as much as $15 billion in 2026, marking a nearly 45% increase from 2025. But before the earnings fireworks, of course, the Fed is concluding its October FOMC meeting and announcing its interest rate decision. Wall Street largely expecting the central bank to cut rates by 25 basis points on Wednesday. Yahoo Finance will begin coverage of the Fed decision at 2 p.m. Eastern. And finally, President Trump is meeting with his Chinese counterpart Xi Jinping in South Korea. The summit coming amid continuing trade tensions between the two countries, but Treasury Secretary Bessent saying on Sunday that there is a very substantial framework for a trade deal. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.